Okay. Welcome everybody to Wall Street Reporter's next Super Stock live stream, June 2nd, 2021. We are back with Reliq Health Technologies, RHT on the TSX.V. Dr. Lisa Crossley, the CEO. Lisa, welcome back.
Thank you. Thanks for having me back.
Yeah, and for anybody that is just tuning in, anybody who's going to be watching this video, a month from now, our goal with these live streams is to bring you those companies which have that 10x to 100x upside potential. As I should even run this little banner thing at the bottom here, like this. So we've had so far 50x. Perhaps we're waiting for that 100x now, Lisa. So yeah, so we're looking for those companies which they have three things in common. One, going after massive multi-billion-dollar market opportunities. Number two, they're at a key inflection point right now, right at the threshold of explosive growth. And there's multiple catalysts in place which could ignite that shareholder value. So anybody watching, all those symbols you see at the bottom, those success stories, and we've had a bunch of others, they all had those things in common. And of course, Reliq also has those things. So Lisa, I think what we should do is, because I'm actually shocked that the stock is still, not reflecting where, the upside potential, and especially based on all the contracts you've announced. So I think we got to kind of, it's like a broken record. You got to repeat everything like 20 times before people finally catch on. I mean, this always happens, a lot of times with companies. So let's start off with, explain to us the market opportunity that Reliq is addressing, and then we'll go into the traction you're getting. So what's the market you're going after? How big is this opopportunity?
Right. So the $100 billion virtual care market for chronic disease management in the U.S. alone. So, it's a fairly defined but extremely large market. If you look at the Medicare and Medicaid component of that, it's excuse me, over 37 million patients. When you get into the private insured numbers, it's well over 50 million. So, excuse me. So it's just massive numbers, and it's a population that's historically been underserved from the perspective of effective monitoring or effective virtual care that actually reduces hospitalizations and ER visits. And so that's what we really deliver, is something that actually works and can serve that very large population that's currently not being served.
So, okay, so to start off with, the big picture is $100 billion addressable market opportunity in virtual health.
Yeah.
Do you want to take I'm going to take a drink of water if you in case.
Yeah. No, it's just, I don't have COVID. It's just my asthma and allergies this
time of year. We got the springtime here.
Yeah.
So the so the market opportunity is 100 billion plus. You have a unique kind of approach. I mean, explain, please, if you can just explain exactly what is Reliq doing. Talk about some of the contracts. How does all that stuff work? And you're based in the U.S., right? That's primarily U.S. is your main market.
The U.S. is our primary market by far. We do have some initiatives in Canada around First Nations in particular, and we are active, excuse me, in Australia. But primarily, over 99% of our business is and will continue to be in the U.S. We focus on what we call the community market. So community is really everything outside of the acute care space. So if you're not looking at someone who's in hospital or long-term care, although long-term care is not really acute either, but essentially it's everything outside the hospital. But what we really do is we bring healthcare into the home. So most of these patients are older, they're often living in remote and rural communities or very dense urban communities where there's not very good access to healthcare. They have these long-term chronic diseases that create these preventable complications, like in congestive heart failure patients, flares of the heart failure. In COPD patients, it's pneumonia. And diabetes patients, it's a whole range of different complications, from stroke to kidney failure to blindness to amputations. But all of these complications are very preventable if the patient receives kind of daily coaching on their management of their disease, and more importantly, monitoring of the way they're controlling their disease. So things like looking at their daily blood glucose readings or blood pressure or peak flow, blowing into something, and if they have COPD, weight, if they have congestive heart failure. And so we're bringing a new approach to healthcare and a new sort of power to the home. So in the home, we can monitor all of these different vital signs or biometric parameters, and then automatically alert the patient's care team if the patient is not taking their medication as prescribed, if they're starting to destabilize. And that allows the care team to intervene early with changes in medication or reminders to take their medication so that the patient can avoid those complications that lead to hospitalizations. So it's something that saves the healthcare system a lot of money. I mean,
and that's the big. I think that's the key thing. So basically, they're paying you, they're paying $50 a month per patient. So it's a recurring subscription, approximately, right? It's $50.
So we receive in revenue anywhere between, at this point, sort of $40 US per month per patient to $100 US per patient per month if we're providing the full care management suite of services. So that's kind of the premium product.
Okay, and essentially with this monitoring, so it's essentially the insurance company, whoever's paying, they're investing roughly, let's call it, $1,000 a year. Let's just say $1,000 a year. But the benefit for them is that they're avoiding potentially a very expensive hospital bill, which could be $100,000 plus, right. And which happens a lot of times with these high risk patients. So it's kind of a no-brainer decision for the provider.
The payers, in this case, let's talk about Medicare and Medicaid, they'll pay the healthcare provider $315 or more US per patient per month to offer this kind of remote monitoring and chronic care management. So we're only charging a very small fraction of that. It's basically all profit for the healthcare provider, or very significant profit for the healthcare provider. But investing that amount of money in patients for the payers, every time those patients go into the emergency room, because they are complex chronic condition patients, that's at least $20,000. And a lot of these patients end up in the ER quite frequently when their diseases are not properly controlled. When they go into the hospital, they're usually looking at an ICU stay of several weeks, and that's hundreds of thousands of dollars. I mean, it can be $500,000 for a congestive heart failure patient or a COPD patient with pneumonia. So the cost savings are really very, very significant. You can put thousands of patients on our platform and save that money by keeping one of your high needs patients out of the hospital for the year. And we've shown that we do that very effectively. So we're on average 20% of a chronic disease population would be hospitalized at least once a year. And that's not even counting the ER visits. We're able to get ER visits and hospitalizations down to less than 1% in the populations who are under our care, who are on our platform. So it's a very statistically significant measure showing that we really are saving the healthcare system significant dollars. And that's really why Medicare and Medicaid over the last 3 or 4 years have significantly increased their reimbursement models around this kind of remote chronic care management, virtual care remote monitoring, where it started out at around $60 a patient per month, and now we're at over $315. And so they've really seen, based on data over the last few years, that they've saved a lot of money by kind of backing these programs. And that's the expectation from Medicare and Medicaid, is that investing $100 billion in this is going to save them trillions down the road. And that's really what they need in order to stay sustainable, in order to continue to exist as a payer in the US. And the insurers, same thing. It's the only way that they're going to be able to continue to profit, because that chronic disease population, we keep people alive for longer now. But that chronic disease, the percentage of the population is growing every year. So we really need to find a way to manage chronic disease patients. They're what account for 70 to 80% of all healthcare spending. So of that $3 trillion that the US spends every year, 80% of that goes to chronic disease patients. So if you want to move the needle on healthcare spending, it has to be by focusing on those patients. And the only way to really make change in their health outcomes is to provide that virtual care on a daily basis, the way that we do with our automated systems, including the automated voice calling and all of that, and to engage the patient and to really make sure that there's a safety net if they do start to destabilize.
So let's talk about so the most important thing, I think the takeaway is really, I'm looking from the investor's perspective, is that, the company's really in the last few months, you really started to gain a lot of traction. You've announced, a bunch of new contracts. Kind of the pace has been accelerating really since, March. You're getting the revenues. You had the first the quarterly results came out. I guess maybe people weren't that happy. They were expecting more. I don't know. The stock dropped for whatever reason.
Yeah.
I
mean, I'd like to address that. I think, no matter what we do or say, people will always look at the quarterly results when we issue them almost as if they're a snapshot of the current quarter. And we have to remember that that quarter was January to the end of March this year, when the pandemic was still in full swing. So the US had started its vaccine rollout, but most of our clients were still spending 95% of their time dealing with COVID, either treating the COVID patients or in some cases with the remote health clinics and, starting to become mass vaccination sites. So they were not delivering their standard healthcare. And you see that in hospitals and other places, even up here in Canada, the backlog on things like elective procedures, that's a massive backlog that healthcare facilities are going to have to work through. So while the pandemic was ongoing, we're a company that from a healthcare perspective prevents forest fires. And if you are in the middle of a raging global wildfire, you cannot focus on how you're going to prevent wildfires going forward. What you have to focus on is the current wildfire and getting it put out. And that's what was happening in the first quarter calendar of this year, is continued from the previous quarters. All of our healthcare clients were very much focused on just keeping their COVID patients alive. In this quarter, however, that's where we started to see the turnaround with our clients. So, in Texas, for example, a lot of those healthcare providers are back to business as usual. Florida, which is not doing well with its COVID numbers, and maybe not so much, but we've seen significant growth this quarter as we expected. Last quarter was not a quarter we expected to see growth. I was pleased that we did see a little bit of growth, but this is the quarter where it really all begins. So you talk about inflection points. I mean, we are literally weeks away from hitting profitability. And every quarter from here going forward, we'll see significant growth. We've always said that the bulk of our growth for this year will happen in the second half of the year. And that's still true. I've been pleasantly surprised by seeing some growth this quarter, but you can already see, there's a process to all of this. So there's, the leading metrics, which are contracts signed, and then they're followed by onboarding numbers, and revenue. And so we've got a lot of patients in our pipeline. Right now, we have well over 250,000 patients that you could sort of refer to them as a backlog. And so that represents, that's $1 billion in revenue. So in revenue. So, let me just highlight that again. That's a very significant
200,000 patients, right? At, I guess, what is it, 1,000? What is it, 1,000 a year or something?
You could say roughly 1,000 a year for the mix between the premium and the.
Okay, so that would be $2 billion in revenue. Okay. When do you think you can get to 200,000 patients?
So, I think there's a zero been added in there somewhere, but so it's at any rate. So we're expecting that by the end of this year, we'll have a minimum of 30,000 patients onboarded. Keep in mind that number, because we report revenue for the month, pardon me. So when we report March, we don't recognize that revenue, and March's revenue until April, because April is when we do the reconciliation of the number of patients who are on the platform with each client for March. So, there's always that, that there's more patients on the platform than you'll see in terms of revenue recognized because of that month lag. And at a point where we are now, where we're growing very rapidly, that month can make a huge difference. So by the end of the year, we'll have at least 30,000 patients paying on the platform. So paying revenue recognized, but likely significantly more. And we will be doing a run rate of about $2 million a month by the end of the year. So we'll close the year at $24 million annually. And we
so 24. So the goal is still 24 million run rate, and by the end of the year.
Okay. Exactly. Yeah.
Okay. And to do, I think you mentioned that 10 or 11 million revenues for in calendar year 21. Okay.
Yeah, we'll do
US dollars, right?
That's Canadian dollars.
It's Canadian dollars. Okay.
Yeah. So we'll do roughly 11 million in revenue this year, but I think the key metric is by the end of this year, we'll be doing, run rate of 24 million with EBITDA close to $1 million a month. So, little over 10 million a year for sure. closer to 12. So, we're already getting into some very significant EBITDA multiples, and you're looking at a business that, similar to, if you look at, I think we've talked about them a lot, Teladoc and Livongo. Livongo was acquired at 70-something times revenue. So the multiples are very significant in this space. And really where you get the higher multiples are where there's significant growth in the business. And we'll definitely be demonstrating very significant growth. So it's a big inflection point for us where we are right now. I think hitting profitability is one of those really key metrics. And what it really translates to for us is when we tell people we're not going to need to raise money, and we get a sense that people are a little bit disbelieving.
Skeptical, right? Because everybody says that. We've had companies say that they're not going to raise, then they raise.
Right. Exactly. They're a little skeptical, but legitimately, we will be self-funding by the end of this month. So we have no compelling reason to do an equity raise. And we can, if we needed additional funds, we can always borrow against receivables, and we have significant receivables. But we're not looking at a situation where we're going to need a big infusion of capital. We're not a hardware business. We're not in the M&A space. So, this organic growth will be fueled by our own free cash that we'll start throwing off by the end of this month. And so we're in a very good position to move forward and to get to really significant revenues on our own dime, essentially, without any further dilution. And I'll sort of further say along those lines, to this point, we've compensated most of our business development and sales and implementation team in the US through stock options. But as we move forward and we're able to, post-COVID, starting this quarter and then accelerating every quarter from here, and turn those numbers, those contracts into actual revenues and patients on the platform, and those resources, those human resources in the US will be compensated by commission. So we're not going to be issuing share-based compensation the way that we have to date. So there'll be very little dilution for our shareholders going forward from share-based compensation, unlike the way that we've handled things to the point where we are now to sort of preserve cash. That's just not going to be necessary going forward because the revenues will provide sufficient commission income for our team down in the States. So I think there's a lot of very good things that are happening going forward. We're going to translate all of those contracts into patients on the platform, and there's going to be very, very little risk of dilution, which is always a good thing. And there'll be profitability, that's significant. Our EBITDA will be over 45% by the end of the year, calendar year, and that's a very significant metric in the space where a lot of these providers are operating at single digit or very, very, very low double digit EBITDA.
Okay, so just somebody had a calculator, so they did the math. So 200,000 patients, it's 200 million because we got the valuation mixed in with.
There's a zero missing there, but the reason I say that 200,000 patients represents $1 billion in revenue is there's other sources of revenue from those patients. There's the premium services that we're offering. Many of those patients will actually receive multiple services from us. So they might be on remote patient monitoring, but also on chronic care management. So, each patient long-term, as we move forward as a company, has the potential to be more significant in terms of the average revenue per user than where we are right now. Right now we've still got sort of our legacy, lots of smaller clients who might be paying less and using fewer services, but we are starting to see more and more of our clients are looking for that premium product, that $100 per month. The other thing I would just remind our audience here of is when I talk about the revenue and in terms of what we recognize, that's in Canadian dollars, so 11 million Canadian. But when we talk about our pricing, that's in US dollars. So we're a Canadian company, we have to report in Canadian dollars, at least for now until we're on the NASDAQ. But in terms of our pricing, since our clients are in the US, then our pricing is in US dollars. When we say that we'll have 200,000 patients at let's say $100 per patient per month, just to make the math simple, that's US dollars. So when we convert that back into our revenue, you add sort of roughly 25%.
Okay, so I think this is kind of the big picture is that, okay, so the opportunity in within the next, I don't know, let's say 18, 24 months is to get to this 200,000 patients. And if you,
I mean, I think over the next 18 to 24 months, the expectation is we'll work with our clients through that backlog. The backlog's not on our part. So when you work with healthcare clients, they are conservative. They have a very standard method for deploying new software, and it involves staged rollouts. And that's very typical. If you look at the way that an electronic medical record is deployed in a hospital system, it'll start at one hospital in, say, radiology, then it'll move to surgery. And so that's kind of the model that healthcare customers are comfortable with. We are finding that as we deploy and are able to actually demonstrate to the clients that there's significant financial upside for them to onboard patients, that picks up a bit over the standard, anticipated pace in healthcare. But basically, we have implementation plans with existing clients who are have patients under contract, such that we have that backlog, if you will, of the 18 to 24 month rollout for that large group of patients. So, certainly in 2022 and 2023, I expect will significantly exceed the guidance we've currently provided to the market. But that's something that we'll kind of address on a more granular level as this year progresses and as we get closer to those calendar years. But I think you can kind of do the math yourself. If you look at getting to a run rate of 24 million annually by the end of this year, a year that 3 to 6 months of which were really hamstrung by COVID, and that gives you a pretty good idea of how quickly we can grow. And certainly we're now at a point where we are working with much larger clients. So I think there's a lot of potential organic growth with this company, and because we'll be cash flow positive, profitable, over the rest of the year, it means that growth comes without the dilution that you might see with, for our business model is focused primarily on M&A.
Okay, so the takeaway. Okay, so this is the big picture. Now, one of the things is that essentially you had the companies had had some setbacks, delays. Hang on, let me just. Okay, so there's been setbacks, delays. The latest has been the COVID thing, which has basically set everything back in the whole healthcare world for the last let's call it 18 months now. So this is and I think probably a lot of people are frustrated with that. I know we have a couple of questions. People say, well, they've been saying that they're going to be doing this, for the last, X amount of years, and why is it going to be different now? And this is there's a lot. There are skeptics in the stock right now.
Yeah.
Now, what I should say is, I personally like situations where the company, has a big story, they have a big opportunity that they're addressing. But things take longer than they were expecting, and by the time that everybody gives up, that's when we kind of get involved at that point where everybody's pretty much given up. And I mean, we've had companies like that where I should run this banner at the bottom of the screen. Okay, so we have this. So some of these stocks which have increased 20x, 50x. These are companies that have disappointed investors for years before they got, and then all of a sudden things change. Things don't always happen in a linear fashion. And then when they do, that is the opportunity. And I think, quite frankly, Reliq is right now very similar to, I don't want to mention names, but a number of companies we've had that have had 10x plus increases in the stock. So I think. Yeah,
I mean, I think if you look at when we started with patients, working with patients in 2017, 2018. 2018 was the first year that Medicare actually covered remote patient monitoring, and they had one billing code, and the reimbursement rate was $59. So the market itself has changed tremendously. When we started out, we were missionaries very much, and most healthcare providers weren't aware of remote patient monitoring or even chronic care management. There were limited billing codes, and initially Medicare and Medicaid were really denying a lot of claims. And they've since made it much easier to submit claims that are eligible. They've made the sort of re-enrollment, the pre-authorization much easier.
It's a little bit like Tesla, 10 years ago when they had problems getting the batteries to last. And the first Tesla lasted only 100 miles. Sometimes things take a little bit longer. I mean, I know the problem is investors don't, a lot of investors, they expect things to happen immediately. However, right now, this could be, this looks like it is actually, so I guess the real question is this finally it? Is this that breakout point, that inflection point where we're going to start to see. And I guess the main question is the onboarding. People are asking, when can we see the onboarding numbers? That's what they want, onboarding, right?
Yeah, I mean, onboarding numbers are something that are quite sensitive in this space. It's something that, competitors generally try to kind of keep confidential, but we'll share as much as we can. Honestly, you can do the math yourselves based on our revenue rates. If you use our average revenue per user, you'll have a pretty good idea of how many patients we'll have on at various points. We'll certainly be going forward providing targets based on quarterly targets in terms of revenue, and may be able to sneak some patient numbers in there as well. But revenue is really, people use patient numbers to model revenue. We're giving you the revenue numbers. It's that's really what you need to focus on, is those revenue numbers, and that we're hitting them. This quarter is extremely key to us. So this is a quarter where we finally, I said to my team when we were preparing for the quarterly earnings that we released this week, this will be the last boring quarter, in terms of our announcements. So, this is the last quarter where we were really slogging through the pandemic, and our clients were really very focused, not on proactive care, but on COVID patients. And going forward, this is when things really start to take off. So every quarter going forward, we'll see significant growth compared to the previous quarters. And, we've talked about the second half of the year is going to be really explosive growth. And that I expect will continue for years. And there's tremendous demand in this market, and we get more and more referrals from other clients every day. And, I think as the US, the nation, in the US in particular, kind of fully comes out of COVID, and some of that will come not even just from vaccination, but, states like Florida that have decided to just kind of let COVID be endemic. And so they have only 36% of the population fully vaccinated, but, they're just kind of going to get to herd immunity through a combination of vaccination and natural infection in the community. Over the next few months, those states are going to start to see a significant reduction in the burden on their healthcare system from COVID patients. Even through that, maybe from a clinical perspective, less than ideal approach. So really, everybody's going to be reopening and more focused on proactive care going forward. And if you talk to healthcare providers in the States, they're talking a lot about how hospitals are really going to be backed up for the next several years. And here in Canada, we're talking about a 4-year backlog on elective surgeries. So there's going to be continuing to be a very significant pressure on the community healthcare providers to keep patients out of the hospital.
Oh, that's a good that adds extra,
right,
a little extra oomph to getting which could drive revenues. Okay, so
right. And I mean, you should expect to see more and more Medicare and Medicaid using their stick on hospital readmissions and on length of stay. So more and more there's going to be pressure to keep patients in the community, which means keeping them healthier. And that's what we do. And we're really, the market leader in that space, because we offer all of the services that are now covered by billing codes. So where it started in 2017, 2018 with one billing code for RPM, there's now over a dozen billing codes for what we do. So we do both remote patient monitoring, chronic care management, transitional care management. That's a new code that's just over a year old. Behavioral health integration, which is mental health care coordination, as well as remote care for patients who have opiate addictions, which is a very relevant issue in the US and everywhere. We provide principal care management. So you've seen us sign contracts recently with nephrologists and orthopedic surgeons. These are specialists who, to this point, haven't been able to access any of these virtual care billing codes. So there are new codes for them that represent significant increases in practice revenue for them. And so there's a huge opportunity for us. And we are at a point where we are recognized as the leader in the space by the healthcare providers. They recognize that we have a platform that addresses all of their needs and that really fits the community space well. We work very well with the target patient population who are older, living below the poverty level in some cases, and have, not a particularly strong interest in slick apps and fancy devices, but just need something that, will meet them where they are, that works in their language. You talked with Prad about California and how important that is. We announced a big contract with California. California is still just kind of starting to come out from under COVID, but they'll be an important player over the rest of the year and beyond. And there we work with, groups that are serving primarily the Asian American community. And, it's a large and rapidly growing community. There's just a lot going forward where we represent something unique in that space, because we offer a multilingual product that works really well with patients who may have either literacy issues or language barriers, or are technophobes like my own parents. So we've got a platform that works really well for this particular target patient population, who are quite challenging. And if you look at healthcare technology, you have to have a lot of very sophisticated technology and software that back your platform. But from the patient's perspective, it has to be something they can use. So for the younger patients, we have slick apps and fancy devices. But for the older patients, you have to have something that will work in a community with no internet access, and that doesn't require them to learn how to use a tablet or a phone or a computer, because they just won't. And so we've been very successful with that. I mean, we have no attrition from our platform, other than, or churn, I think some people would call it, other than if patients pass away, and those patients are rapidly replaced by their healthcare providers with other qualifying patients. So, we have really good adherence with our patients, which is why we get such good clinical results.
Okay, so essentially, I think that the story, the way I look at this story is this, right? I mean, you're looking at a huge market opportunity. The reason the stock is cheap right now, I mean, we could just address it, is, people, this has been a kind of a pioneering company in this space, right? And how long? Again, I use the Teslas. I mean, using Tesla as an example because it's very similar. I remember seeing a Tesla in 2008. I think there were, I don't know how long ago, but I remember seeing a Tesla. I was like, wow, this is like a piece of crap. And this was like when they had that roads, whatever. I still think the car is stupid, but whatever it is. But they had issues then, getting the batteries, and they had all sorts of issues. And they had manufacturing issues, or whatever it is. But that stock, all of a sudden, they hit this inflection point where all of a sudden things started, the market caught up, the technology is caught up, and things caught up, and then all of a sudden you have, one of the most valuable companies on the planet. And the same thing in this case is very similar. Like you had, when you started, you didn't have the billing codes, the Medicare billing codes, which allowed you to make, so there's a lot of, basically you started really before the market was really available in terms of, for sales, for reimbursement and all that. So now it's available. You're finally, things have, and then you had the COVID thing that set things back 18 months. Yeah. So finally you're at the right place at the right time. And this is, I think, the point where investors can look at this and say, okay, the market cap is what is it, like 70 million right now, 75 Canadian, I think, roughly.
Yeah, something like that.
Ballpark. So if you get to these, so I look at this, okay, if you get to this 200,000, patients in the system, you have a potential 2 billion market cap. So it's a 20x upside. However, I mean, that upside can kick in before you get to 200,000. I mean, I think if you get to 100,000, I mean, first of all, I think if you can overcome all the doubters, all the skeptics, and we have a lot of these skeptics online right now who've been in the stock probably for a while. So again, and one of the questions is, okay, so they want to know is, I guess, what's the bottleneck? How are you going to overcome this? I guess with the capacity for the onboarding. How many can you onboard a month? How are you realistically going to get to this, $11 million revenues? Those are the big questions.
Yeah, I mean, we are not a bottleneck on our end. So really what has happened is the healthcare providers were constrained by COVID, and then they've got implementation plans that are fairly conservative. We expect that as we move forward with larger and larger clients, the implementation plans will be more aggressive. But we're not constrained in terms of the number of patients we can onboard. We can easily onboard hundreds of thousands of patients a month. So there's never going to be a capacity constraint on our part. And it's very easy to onboard patients. It's really just that kind of pre-work of, getting the healthcare organization to agree to an implementation plan, and then, having their buy-in and getting the patient lists from them. That's something that happens more slowly with the smaller clients, and we'd certainly started with the smaller clients. It happens much more quickly with the larger clients, and the larger clients are really what we've been announcing this year. So, by the end of this year, I think you'll start to see a much more aggressive rate of onboarding, but I still think, the onboarding rate is going to be quite impressive for the rest of the year, but it's definitely something that will scale by orders of magnitude going forward every year. And, it is one of those kind of snowball businesses where, you start relatively small, but it gets big quite quickly. And once it's big, it really is very autocatalytic and stays very big.
I think right now, I get the sense that a lot of investors, who've probably been in the stock for a while, maybe it's like, okay, they've kind of given up hope. It's okay, this is the onboarding. They're never going to get the patients, whatever it is, and that's the thing that's so. I think if you show at this point any kind of upside surprise, I mean, any the small, in other words, the expectations right now are set very low for this. I mean, like, with the current market cap and everything, it's basically the market has very not very high expectations for the stock or for what you're going to deliver. So if you can show any kind of real traction, then all of a sudden people are going to say, "Wow, we better get on board before the rocket leaves to Mars." I mean, it's
I mean, if you think about it realistically, in my conversations with institutional investors, small hedge funds or family offices or small funds in general in the US, they're all waiting for profitability. That's kind of the key point at which they feel the company is de-risked. And we're very happy to be a show me company. I think we're now at a point where every quarter going forward, we'll be able to really show the market and that everything we're saying is conservative, and that we're going to hit these milestones and then some. But I do think that what's going to happen is in the coming months we're going to get a lot more institutional investors in the US because we will have hit that key profitability de-risking milestone, and those tend to be investors who hold for longer than kind of the stereotypical retail shareholder, although we've had some wonderfully patient retail shareholders who've been with us for a very long time. But I think that's going to eliminate a lot of the volatility in the stock. And I think the fact of the matter is, to this point, everyone has had to just kind of rely on our word for it, that, things are going to get better, that post-COVID, everything's going to fall nicely into place. But by the end of this month, you're not going to have to take our word for it anymore. You're going to have quantitative data around revenue and profitability that will show you that the company is delivering, and then that data will continue every month, every quarter, going forward for years, showing you significant growth. And I think the U.S. market will respond in particular to demonstrating that you really are delivering. So I think as we get more and more exposure in the U.S., which is our goal for this year, given that the U.S. is our primary market in terms of customers, I think we will start to see more appropriate valuations that really take into account the growth. And a lot of the valuations in our space and in healthcare technology in general are focused on, leading metrics. So, it's looking at the future.
It's I think, okay, so, it's interesting because you're coming on right after, right before we had one of our companies, one of the first companies from our platform that's going onto NASDAQ.
Yeah.
Or actually in this year, we had a company that went to the New York Stock Exchange last year.
Yeah.
That was a Fubo, which, it's interesting. Again, that was a company, when we introduced that company, it was called FaceBank, and people gave up. Very similar. It's the same narrative. I mean, I heard the story. This is like, broken record. So people gave up on that company. It was like, whatever. Then they merged with this Fubo, which is the live streaming thing. And all of a sudden, that stock went to like $60 on the New York Stock Exchange. So I think the time to really look at these stocks is when, I like these things when everybody is giving up on something. There's skeptics, doubters, haters, and because then you have, as soon as you have some little traction, you get that all of a sudden everybody jumps on. So
well, and I think instead of thinking of it as everybody hates it. The way I always look at companies that are in similar positions is, if a company has been stress tested to this point and has still been able to survive,
that's why,
would have, they talk about the analogy.
It's been de-risked. Basically, I look at it as a de-risked. I mean,
and there's been significant investments to date by other shareholders. If you're a new shareholder, that's gone towards developing the platform. That asset, has real value, and that's where the bulk of our funds have gone to date. So, any penny in has not been wasted. It's gone to develop that asset. It's also gone to develop our expertise around billing. We now have software that does automatic pre-authorization. So, we know when we onboard a patient that we're not taking our healthcare provider's word for the patient's eligibility. We actually have that in hand from the payer, so we know we'll get paid. And so, the company has, as you say, largely been de-risked. It's definitely had a trial by fire, or maybe a few trials by fire, but it's not only survived through those, but is now at a point where, we're really poised for significant growth. And I think that speaks a lot to the team that we have and their talents. And I think it also speaks a lot to how much what we have is needed in the healthcare space, that despite healthcare being a very conservative market and the company having had some stumbles, which would normally scare off healthcare clients, we have and continue to build a very significant customer base, because what we are delivering to the market is exactly what they need. And it's very financially compelling for the healthcare providers, but it's also, really good for patients in terms of health outcomes, and therefore very good for the payers in terms of controlling healthcare costs. So I think we're now at a point where we finally, are going to be able to be the show me company and show, consistent, significant growth every quarter going forward, and, profitability, which is a really key milestone. So I think this is, we've been talking about being at an inflection point, but we're really at that inflection point where we're literally weeks away from being past that inflection point.
Okay.
And, I think this is an exciting time.
I started talking about, I got distracted. I was talking about the case, but basically, so the first company right before you, we had that's going on NASDAQ next week. I mean, and again, companies say, they're going, and this, they got the symbol. So next week is, although I'm sure right now people say, oh, it's never going to, but it's already been, it's official. Okay. So the question is, what's your plan for NASDAQ? Because really, this is a NASDAQ type of story. I mean, if you were a NASDAQ right now, the stock potential could be 5x higher. I mean, just based on, that's the more receptive market. The Canadian market doesn't really understand this type of story. It's a U.S. thing mostly,
I think it's just, if you've grown up in the U.S. healthcare system, this just intuitively makes more sense than if you've grown up in a socialized medicine system. So I think that you're right. The U.S. is the right audience for us, and certainly, NASDAQ is the right audience for a U.S. healthcare technology company. So our expectation is that we're going to start working on our uplisting, and that, as soon as we are able to, we're going to uplist to the NASDAQ. That's our focus going forward, is that exchange. I think it definitely gives us the right audience, and that will give us the right valuation.
I would say, one thing that, I mean, maybe I should tell you this off there, but basically, okay, so it is like, for example, I think in the case of like Skylight with the NASDAQ, I think what's really helped push that process along quickly is the fact that, they have, their bankers like Raymond James, I think Steve. And if you get, so I think it's like, if you can, and I think, I don't know why, you'd be a perfect client for like a Raymond. I'm not on commission for Raymond James or any of these other guys, but I mean, you get a big US like an Oppenheimer, like that's, if you get those guys on board, that'll make the NASDAQ thing really a done deal, basically. I think that's been the missing ingredient for companies that haven't made that.
Yeah, we work very closely with Canaccord Genuity and their U.S. partners. So, we're not lacking in investment bankers with expertise to help us with that transition to the NASDAQ. Certainly, it's not something we're going to try to do on our own.
Right. It's not this month. I mean, it's not, but so let's say 6 months, 9 months out, it's a possibility.
Oh, it's definitely, yeah.
Okay. So I kind of wanted to recap. Okay. So the milestone, we didn't even talk about the milestones over the last quarter. So the last 3 months, let's talk about some March, April, May contracts. Let's just go through everything that's been done, which,
Yeah, I mean, we've signed contracts with new specialist practices, and we are expanding our business with existing clients, because they are finally able to not focus on COVID. So, for example, the remote health clinics and the federally qualified healthcare centers. They are large groups that serve primarily underserved communities. We've got 27,000 patients under contract with just a few of those facilities that will onboard over the next 12 months. And so we are finally able to get back to onboarding with some of those existing clients, but we've had a lot of interest from new clients, everywhere from California to Puerto Rico to Texas and Florida and excuse me, the Midwestern United States. So we've got a lot of new clients as well as existing clients who are finally able to get back to focusing on proactive care. So we have, a very good pipeline of patients that we can start to onboard. And of course, we're constantly signing new clients. So I think what you'll see, it may not have really resonated with people when we announced that we've adopted the FHIR standard, or the fast interoperability healthcare standard, but that's going to be required by Medicare and Medicaid beginning July 1st. So healthcare providers and payers in particular are going to have to support that interface in order to provide patients with access to their data. We have a FHIR-based patient portal, so we can work with these very large payers, the managed care organizations, private insurers, who have millions of patients. And we're uniquely positioned to work with them because we can provide that FHIR interoperability that effective July 1st, they're going to be fined if they don't provide. So, we've positioned ourselves as having something very unique in the market, particularly in the community care space, that serves these very large clients. So as the business moves forward, we're going to definitely be transitioning to larger and larger clients. So, the patient numbers will increase very substantively going forward.
Okay, excellent. On that note, I guess so. The issue is people want to know is the pace of onboarding. That's the big thing that people are going to be watching. So yeah. I would say let's kind of wrap up here. In terms of news flow, what can we expect in the next? It's the summer already. We're in June, so are you going to have an exciting summer, or what are we going to have?
We're not going to slow down in the summer, that's for sure. It's definitely going to be a very big summer for us, and we're very active in business development, and we've got a lot of, I think, very exciting news to come. So there'll certainly be significant news flow. I mean, it makes a huge difference to our business that we're at this point in the pandemic where the vaccine rollout has really been quite successful. So as we've always said, the second half of the year is going to be very explosive growth, and there'll certainly be very significant news flow associated with that.
Okay. What would you say that, like right now, again, let's to recap, and we always ask, in your opinion, what would you say the top 3 reasons for investors to consider, Reliq stock today?
Yeah, I mean, I think we are at a rare inflection point. So we're at a point where the company is really weeks away from being able to publicly disclose having been de-risked. But we've always said that that's what's going to happen at the end of this month. So I think relative to that milestone, we're tremendously undervalued right now. So this is a very good opportunity, to kind of get in and get a bargain. I think the company's in a market that's relatively new, but we're no longer, the pioneers who are getting slaughtered crossing the country. We're the settlers, and we're done that missionary work. We're at a point where it's something that there's a lot of market pull for. We're not having to push, and it's a very large and very rapidly growing market, at over $100 billion US per year. And I think we have something quite unique in that space, and we have the reputation and the credibility as the market leader. So, in the clinical circles, we're the first choice. So we're poised for very, very significant growth, and I think this is a unique opportunity to get in early in one of those stories.
Okay. Excellent. Lisa, on that note, I want to thank you, and thank you everybody for joining our live stream today, and we'll see you on the next one. Thank you again, Lisa.
Thanks, Jack.